Roughly 2 weeks ago, OSFI, Canada's top banking regulator, made a statement that sent shockwaves through the mortgage industry. Mortgage brokers, realtors, underwriters, investors, even the forums on Reddit, everyone went into a full panic mode. The reason? OSFI said that income being used for one mortgage can't be used for another property. Now, when you first hear that, it sounds confusing, but imagine this. You own your home, you've got a stable job, and you're looking to buy your first rental property to start building long-term wealth. And suddenly the regulator steps in and says, sorry, you can't use job income again to qualify for that mortgage. If that were true, it would have been the death of small real estate investing in Canada. And for a few days, that's exactly what everyone's thought is happening. People were calling lenders, investors were freaking out, brokers were trying to make sense of what OSFI even meant. I had a client messaging me saying, Justin, is this for real? Are they actually banning income reuse? The industry went into chaos, and honestly, who could blame them? This kind of change would have locked out thousands of everyday Canadians trying to grow their rental portfolios. But here's where things get interesting. A few days later, OSFI quietly clarified the statement. No press conference, no big announcement, just a quiet update. They said you can still use your income for multiple mortgages, not just the same portion of it. In other words, you can't double count your income. So if you earn $100,000 a year and your primary home needs $40,000 of that to qualify, you can only use the remaining $60,000 for your next property. Now, believe it or not, that clarification actually calmed people down. But when you dig into what OSFI actually meant, it raises a much bigger question about where mortgage regulation is heading. Because this isn't about your income, it's about control. OSFI's not changing how you qualify for a mortgage, they're changing how banks classify those mortgages behind the scenes. And when banks change how they classify loans, everything else starts to shift. Rates, risk, access to credit, and the future of the small investor in this country. This isn't random, this is part of a much bigger pattern that we've been seeing for months. Regulators tightening the screws on investors while saying we're just protecting financial stability. And look, I get it. OSFI's job is to protect the system. But every time they clarify something, it seems it's making it harder for the average Canadian to get ahead. So in this video, I'm going to break down what OSFI actually said, why it matters, and how this single change could signal the long-term shift in how Canadians treat rental property investors. Because even though this isn't as catastrophic as people first thought, it's still a sign of where things are heading. And if you're a small investor, you need to understand it now before November 1st hits. All right, so now that we've got the chaos out of the way, let's talk about what's actually happening, because OSFI's clarification isn't as harmless as it sounds. So here's the deal. After days of confusion, a mortgage news outlet, Mortgage Logic, reached out to OSFI directly for answers. They finally got a written response, and it confirmed what a lot of us suspected. Yes, you can still use your income to qualify for multiple mortgages, but only the income you haven't already used. So let's break it down. Say you make $100,000 a year. Your home mortgage requires $40,000 of that income. That leaves you with $60,000 that you can use on the next property. Under this new guideline, you can't count on that same $40,000 again. Your income doesn't reset with each new property. It gets divided up as your portfolio grows. Now, at first, that sounds fair. You shouldn't double count your income. But here's the kicker. This clarification changes how banks have to classify your mortgage. Because OSFI didn't just issue a reminder, they redefined what's called a material income dependent loan. Basically, OSFI wants banks to flag any mortgages that rely heavily on rental income to make payments. If more than 50% of your income used to qualify for that mortgage comes from the property itself, meaning rent, it's now considered income producing. And when a mortgage gets that label, it triggers something massive in the background. The bank has to hold more capital against that loan. Here's what that means in plain English. When a bank gives you a mortgage, they're required to keep a certain amount of money set aside, like an emergency fund. It's called a capital reserve. The riskier the loan, the more money they have to hold. So when OSFI says, hey, this property depends mostly on rental income, it's riskier, that means banks now have to stash away more cash for every one of those loans. And if a bank has to hold more money, that money can't be lent out somewhere else, which ultimately makes lending more expensive. And that cost eventually lands right back on you, the borrower. Now, industry insiders are saying this could push rental mortgages up by around 0.05 to 0.1%. Now that might sound tiny, but on a $650,000 mortgage, that's roughly $1,500 more in interest over the term. And that's before any tightening on qualification or capital rules that could follow. But let's look at how this plays out in real life. Property number one, you buy your first rental. You use some of your job's income and rental income to qualify, no problem. Property number two, you do it again. Now you've used more of your income, but still under the 50% threshold. By property three, your personal income is stretched across two mortgages, so you're relying on more of the rental income. That's when OSFI's 50% rule kicks in. Once that happens, your new mortgage gets flagged as income producing. That means the bank has to hold more capital, which means your rate goes up, qualification gets harder, and suddenly you've hit a ceiling. Under the old system, you could grow faster because lenders look at your total income and debts together. Now you're going to hit that wall much sooner. And here's what OSFI is really saying. We want banks to treat rental properties more like commercial loans. That's a big shift, being moved into some riskier categories as business borrowers. And once you're labeled as higher risk, you pay more. It's plain and simple. Now, why is OSFI doing this? Because they're looking at the data and it's not pretty. In markets like Toronto and Vancouver, rental yields are dropping, vacancy rates are rising, and a lot of properties bought in 2021 and 2022 at record prices, at record low rates, are now losing money every month. OSFI sees that as risk to the banking system. If too many investors get squeezed and start missing payments, that pressure hits lenders. So they're tightening early before that risk turns into reality. From their perspective, it makes sense. From yours, as a small investor, it makes things harder. Because when regulators do this, it doesn't just change the rules, it changes who gets to play in the game. Big institutions, pension funds, and REITs, they have commercial funding and deep pockets. They don't blink at a 0.1% increase. But the average investor, the family trying to buy their first duplex or triplex, they feel the change immediately. And that's what makes this so important. This isn't about stopping risk, it's about changing who gets to take it. If you're a small investor trying to build long-term wealth, this change matters because it's quietly redefining the future of real estate ownership in Canada. So where does this leave us? The new OSFI rules officially take place November 1st of 2025. That's when the big six banks start applying these rules, income producing loan definition. Now, this isn't a doomsday headline, but it is the start of a new phase for Canadian investors. And here's what to expect. 1. Rental property mortgages will likely tick up a bit. I anticipate anywhere from 0.1 to 0.5% higher. Not massive, but enough to chip away at your returns. Number 2, underwriting will tighten. Your third or fourth property will face more scrutiny. Expect lenders to ask for bigger down payments, better cash flow, and stronger credit. And 3, more deals will move towards alternative space, credit unions, non-bank lenders, or even commercial lending. And that's not necessarily a bad thing, but it is a shift. When regulators tighten, opportunity moves. The investors who adapt will win. So here's what you can do now. Step 1, if you're planning to buy or refinance a rental, consider doing it before November 1st. You'll still qualify under today's rules. Step 2, adjust your numbers. Build a small rate cushion into your calculations. If your deal still works, you're in great shape. Step number 3, work with a professional who actually studies this stuff. Mortgage broker who understands OSFI's updates, who can position your file properly, and who knows lenders beyond the big six banks. Because this isn't about mortgages, it's about strategy. Long term, these changes are going to separate two types of investors. Those who ignore the new landscape and those who learn how to navigate it. OSFI sees risk building in the rental market and they're acting before things break. It makes sense for them, but for you, it means one thing. The era of easy money in real estate is over. From here on, it's about smart money, smarter deals, smarter financing, smarter planning. Honestly, that's not a bad thing. It's going to force investors to be sharper, more disciplined, and more strategic. Don't panic, just be prepared. Understand the new rules, adjust your strategy, and make sure you're working with people who know how to navigate this stuff, because this won't be the last regulatory change we'll see. OSFI's message is clear. More oversight is coming, and investors who pay attention now will be miles ahead when it's done. I'm Justin Chaussee, your mortgage expert, and if you found this helpful, please subscribe, drop a like, and share with someone who owns a rental property or plans to. Because this kind of knowledge isn't just information, it's leverage. I'll see you in the next video.